Happy Tuesday out there, folks. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, June 7th, 2022. Starting with markets, we have stocks down this morning, commodities down this morning, crypto down this morning, dollar up, global bond yields down. Market moving headlines. Remember, you heard it here first with respect to the profits cycle recession that's now morphing into our base case scenario. We'll talk about that more in our June 22 macro scouting report. 132 or 133 slides of hard-hitting, action-packed, world-class analysis, if I do say so myself. This is my program, so I'm happy to say so. But anyway, Target is tanking pre-market after cutting its profit outlook for the second time in 3 weeks. On more fallout from the inflation surge that's whacking consumer spending. It aims to ease excess inventory, which is something we started talking about 6 months ago, by marking down more merchandise and canceling orders. That doesn't have an impact on growth and hiring in subsequent months and quarters. What will? Operating profit will amount to about 2% of sales this quarter, less than half of its May 18th prediction. So it is June 6th, and one of the largest retailers in the world has cut its profit forecast in half from where it was 3 weeks ago. Tell me that's not an issue. Tell me this economy isn't really starting to pick up steam to the downside. And these are some of the early leading indicators. Obviously, if Walmart, Costco, Kroger's, Macy all falling in sympathy pre-market, the hit to retail consumption, the hit to broader consumption, the hit to broader economic growth will not be linear. It'll hit certain companies before it hits other companies. Certain companies will beat, certain companies will miss. But by the end of this process, profits will be a lot lower, growth will be a lot lower, stocks will be a lot lower, crypto will be a lot lower, and most likely bond yields will be a lot lower. So we continue to reiterate all of our medium-term views with respect to the cycles. Liquidity always dries up at the margins. First, bear market has not been kind to U.S. tech companies that went public during the pandemic. More than 80% of tech-related IPOs since the bottom in March of 2020 are trading below their listing price, according to data compiled by Bloomberg. The losers include Robinhood, which is down 76% from its listing price, Rivian down 63%, and Bumble minus 48%, which have all tumbled as investors are ditching the riskiest stocks. Don't forget my favorite riddle. And when it comes to bear markets, what do you call a stock that's down 90%? Answer: a stock that was down 80% and got cut in half. So don't forget, the percentage change math works against you. It's compounding in the same way that it compounds up and it works in your favor on the upside. It works against you on the downside. You can always lose 100% of your money from any given price. And then today, official QT officially begins. So today's auction of $44 billion of 3-year notes from the Treasury will be the first auction affected by the Fed's balance sheet reduction plan. Instead of reinvesting $15 billion of debt maturing June 15th into this week's sales, the bank will only reinvest about $5.6 billion. So, just a little bit over a third of that. So big deal here. Big deal. If the Fed's only going to take down about a third of U.S. Treasury auctions, that's going to be an issue because we have to feel the other 2/3. I talked about this going back to the Real Vision daily briefings in the fall. The return of the bully, the schoolyard bully, is coming here to collect this lunch, and the schoolyard bully to collect your and our lunch money. And his name is the U.S. Treasury. He's been well capitalized by the Federal Reserve, really throughout this sort of COVID period, really since March of 2020. And now, guess what? Federal Reserve is now in middle school, and we're still here in elementary school, and the bully is sticking around because guess what? They got held back, and now we're about to get bullied up by quantitative tightening. So just brace yourselves for that. It's not going to be a linear process. The market's not going to be down every day during QT, but the reality is, as we continue to suck liquidity from the system, we do a very significant deep dive on the liquidity cycle in the June 22 macro scouting report, which will be out this afternoon. You're definitely going to want to see some of those slides because I think we're probably about as negative on the liquidity cycle as some of the most prominent thought leaders out there in that space. Big movers this morning. DAX down 1% to up 6% month over month. That was actually surprising to me to see the DAX up 6% month over month. That is a little bit outperforming U.S. stocks, which is contrary to sort of the narrative around Europe being in recession, the U.S. Being able to engineer a soft landing. Bloomberg Industrial Metals Index down 2%. Obviously, When you're talking about growth slowing and you're talking about liquidity reductions, you're going to see a hit to industrial metals. That's the most economically sensitive part of the commodity market. That's down 1% month over month. Bitcoin down 6% to down 18% month over month. Ethereum down 6% to down 35% month over month. Lord help you if you got plugged into those when we told you get out of them. So anyway, we're always here. It's about the next play. No matter how you got here, whether you're down 35% month over month in Ethereum, or whether you're sitting pretty because you sold it up 35% a percent ago, doesn't make a difference. Today is all about focusing and reorienting your focus budget to the next play. And we're grateful that we're part of your focus budget and your investment journey. We don't take that lightly. We definitely want to be here to help. Shifting gears to our volatility adjusted momentum signals and probable ranges. US dollar, that is still bullish FAMs. In the middle of its probable range, 0.9% of downside versus 1.2% of upside. Gold, that is still bearish FAMs, got minus 2.8% of downside versus 1.1% of upside. 10-year nominal treasury yield bullish FAMs, bouncing off the upper boundary of its probable range with minus 27 basis points of downside and 6 basis points of upside. Maybe we've seen the peak in bond yields. We'll see. I'd like to see some. I want to see how this thing really trades during QT. And if it seems like it's going to trade well during QT, then we'll be keen to allocate some resources there. Made a really thoughtful and what I was very clearly a smart risk management decision not to sort of put on that EDV position we outlined in the Macro Trading Floor podcast. We'll eventually put it on when we think the signal is right. The signal wasn't right at that arbitrary date, so we didn't put it on in the 42 macro portfolio construction, but that's neither here nor there. What is here is high yield OES that is still bullish FAMs, minus 19 basis points of downside versus 52 basis points of upside in the probable range. S&P 500 bearish VAMs, minus 7.5% of downside versus only 1.3% of upside. VIX neutral VAMs, minus 14% of downside versus 23% of upside. NASDAQ 100 bearish VAMs still, minus 10% of downside versus 1.9% of upside. Russell 2000 bearish VAMs still, minus 9.1% of downside versus 0.5% of upside. Bitcoin bearish VAMs, minus 10% of downside versus 6% of upside. Look how thin that range is. I mean, that's what happens when you consolidate for 4 or 5 weeks at a time. Ethereum bearish VAMs, minus 11% of downside, 11% of upside. Middle fair fight there. Shanghai Composite neutral VAMs, not a fair fight. Still at the upper bound of its probable range, where it's been for like 3 weeks now. This thing wants to break out the bullish VAMs, and I'm not even sure bullish VAMs will spare the probable range, give the probable range some relief. This is a market that is being allocated to institutionally. Whenever you see a very low, very high Sharpe ratio recoveries off of a low, that's telling you that somebody is buying in size, and they're eating up they're lifting every offer, and they're trying to get into a big position. So perhaps one of our large institutional clients got the look-see on the long China view here. WTI crude oil bullish FAMs here, minus 7% of downside versus 5% of upside. Agricultural neutral VAMs here, minus 2.3% of downside versus 4.8% of upside. And then lastly, industrial metals, we talked about that earlier, minus 5% of downside versus 1.9% of upside. So with that, Darius Dale presenting our macro minute for Tuesday, June 7, 2022. And again, as a reminder, we'll have our June macro scouting report presentation out this afternoon. It'll be the best thing you review all month. So definitely go check that out. Cheers.